Hello and welcome to our Outlook 2026. The global economy showed resilience in shocks in 2025. But in 2026, growth will not be able to sidestep the reality of US tariffs and political uncertainty. Tariffs are here to stay. They will continue to slow trade, impact corporate profits, and raise prices. And even if the Supreme Court were to rule the application of some tariffs illegal, the Trump administration would then probably reimpose them differently. Many US consumers have enjoyed a wealth boost that is unlikely to repeat in 2026. Slowing consumption and labor market weakness will push growth below its potential. After pausing in the first half of 2026, the Federal Reserve should resume rate cuts under a new Fed chair, reaching 3% by year-end as tariffs impact on inflation subside and labor market risks rise. So what about the outlook? Growth should be soft and unspectacular, but there are safeguards. Fiscal policy is expensive in many economies, and monetary policy will provide support. In the Eurozone, the European Central Bank has delivered, inflation is on target, and policy rates should hold at 2%. Growth should remain near 1%, helped by steady rates, stronger credit, and German fiscal spending that offsets tariff headwinds. In the UK, policy rates should fall below 3%, cushioning some of the fiscal tightening. In Switzerland, the outlook has improved following the US trade deal, and we see rates holding at zero. Negative rates are a last resort tool if growth stutters, but a fiscal boost would be much more effective. In China, we expect a gradual slowdown, with government support keeping growth above 4% in 2026. Chinese stimulus should help emerging markets too. Easier funding, global capital spending, and stabilizing trade have made emerging markets the strongest macro story. But what about the risks? Cracks in the US labor market, political interference in US institutions, fiscal strains, or a reversal in AI sentiment. And of course, geopolitics can always disrupt supply chains and energy markets. But as long as these risks remain contained, economies can expand. For markets, the bar is high. So let's hear from Michael what this means for our investment strategy.
Despite instability, markets thrived in 2025. Lower interest rates, positive economic growth, solid earnings growth, and strong public and corporate investment can all sustain momentum. We see opportunities across risk assets, especially in emerging markets, and some real assets like gold. We stay invested, but vigilant. Countries are spending on strategic autonomy. That's rewiring capex into tech, infrastructure, and defense. There will be winners, and we are already seeing some effects in emerging markets and gold. At the same time, AI has driven this market cycle. Sentiment shift and US equity valuations are certainly stretched. But let's not get ahead of ourselves. The risks of a bubble are not the same as the dot-com era. Today, corporates are delivering strong earnings and balance sheets. Still, because US valuations are high, we have broadened our equity allocations to regions and sectors offering more reasonably priced growth. In developed markets, we remain neutral and favor Switzerland's quality exposure and solid dividend yields. We stay overweight emerging market equities. These should extend gains on stronger earnings growth potential. A weaker dollar and US-China trade truce should also help. In sectors, trends in electrification, infrastructure, and AI investment underpin our preferences for utilities and materials. The outlook for healthcare should also improve. In fixed income, we keep global allocations at strategic levels, favoring emerging market hard currency bonds, which offer an attractive value proposition. It is a different story in developed markets, where sovereign bonds face debt and fiscal pressures. The exception is UK gilts, where falling inflation should help the Bank of England cut rates. In currencies, falling US interest rates should weaken the dollar. In volatile times, gold still offers more diversification benefits than sovereign bonds. Strong investor and central bank demand, limited supply, and falling real rates are all supportive. So, does this bull market still have legs? In a word, yes. As long as the economy keeps absorbing uncertainties, this cycle can extend in 2026. We stay disciplined as risks abound. By ensuring strong portfolio diversification, we build in resilience and stability for the road ahead. Thank you for watching.